Okay, so finance today, it feels like.
Oh,
It's just constant noise, right? You've got the lure of quick money, this fear of missing out, FOMO. And then the daily headlines just swing your mood all over the place. It's chaotic.
yeah.
How do you even begin to navigate that, to build like actual long-term wealth?
Well, that's exactly why today we're diving deep into a real cornerstone work, Benjamin Graham's The Intelligent Investor.
Yeah, and it's not just any old book, is it? People call it the Bible of value investing. And I mean, when Warren Buffett says it's by far the best book on investing ever written, well, you pay attention.
You really do. So our mission here really is to unpack the wisdom in this book. It's nearly 75 years old, but is it still relevant? We want to explore its core ideas and figure out why it's still seen as indispensable, even with markets moving so incredibly fast now.
And to do that, we've really gone through it, pulled out the key stuff from a detailed review. Think of this as getting you up to speed on the foundational thinking behind smart long-term investing, not just a surface skim. Absolutely. So before we get into the pillars, let's talk about the man himself, Benjamin Graham. Who was he? I mean, beyond being Buffett's mentor, which is kind of a big deal.
It really is. He's known as the father of value investing, a legendary economist, investor. His work fundamentally shaped how we even think about financial analysis today. He wasn't just a practitioner, he was a thinker, an academic.
Right. And the book itself has a history too, doesn't it?
It does. First out in 1949. But the version most people talk about, the one that's probably most useful now, is the 73 edition. Crucially, it was updated in 2003 with commentary by Jason Zweig.
The Zweig commentary. Why is that so important?
Well, because Graham's original examples, railroads and utilities from the mid-20th century, they can feel a bit dated. Zweig bridges that gap. He takes Graham's timeless principles and applies them to modern situations, modern companies. It makes it click for today's world.
Okay, that makes sense. So who should be tuning in? Is this deep dive and the book really for you, the listener?
The sources suggest it's aimed squarely at, well, serious investors, also finance students, and really anyone who's genuinely interested in building wealth over the long haul, not just chasing trends. If that's you, stick around.
Perfect. Okay, let's get into the meat of it then. Graham's pillars of intelligent investing. He starts with this really fundamental distinction, doesn't he? Investor versus speculator.
He does. And it sounds simple, maybe even obvious now, but the way Graham defines it is key. An investor, for him, is analytical, patient. They focus on the actual value of the business and aim for long-term returns. Safety first, then return.
Whereas the speculator?
Speculator is chasing prices, reacting to market buzz, maybe getting caught up in emotions. Often, Graham implies they end up losing. His famous quote nails it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else is speculation.
Thorough analysis, safety of principal, adequate return. That sets a high bar. So you, listening, might want to pause and think, which approach really aligns with your goals?
Exactly. And that leads directly into maybe his most famous concept, the margin of safety. This is like the investor's shield.
Okay, explain that. What is margin of safety in practical terms?
It's pretty straightforward conceptually. You figure out what you think a company is really worth its intrinsic value. Let's say you calculate that at, $100 a share. The margin of safety means you only buy it if the market price is significantly below that. Maybe $70, maybe even $60 or $80.
So you're building in a buffer.
Yeah.
Against what? Errors in your own analysis. Bad luck.
Both, really. It protects you if your valuation wasn't quite right, or if things just go unexpectedly wrong for the company or the market. It's your downside protection, your safety net.
Okay, so find a good company, calculate its real value, and then wait until you can buy it cheap. But calculating that intrinsic value, that sounds like the tricky part. Does Graham give you a magic formula?
No magic formula, unfortunately. It's more about a disciplined process. Graham was big on fundamental analysis. Digging into the financials, earnings, dividends, assets, debt, the company's financial health, its competitive position, its work. It's definitely more art than science, blending rigorous analysis with a healthy dose of judgment.
Right, no shortcuts. It requires real digging, which seems very different from just reacting to the market's daily swings. And speaking of market swings, let's talk about Mr. Market. I love this metaphor.
It's brilliant, isn't it?
Oh.
Graham imagines the market as this business partner you have, Mr. Market. And every day, he shows up offering to buy your share of the business or sell you his share. But the prices he quotes are, well, they're all over the place. Sometimes wildly optimistic, sometimes ridiculously pessimistic. He's moody.
So the lesson is,
Don't get caught up in his moods. He's there to serve you, not to guide you. If he shows up depressed and offers to sell you his share for way less than it's worth, you take advantage. You buy. If he's euphoric and offers a crazy high price for your share, maybe you sell. You stay rational when he's being irrational.
It's amazing how this predates so much of modern behavioral finance. He really understood the psychology of markets way back then.
He absolutely did. He saw how emotions, fear, and greed drive market prices in the short term.
But isn't it incredibly hard not to be swayed by Mr. Market today? With constant news, phone alerts, how do you maintain that discipline Graham talks about?
That's the million-dollar question, isn't it? It takes immense discipline. Graham understood it was a battle against human nature. It's not just about ignoring the noise. It's about having the conviction in your own analysis to use the noise, to use Mr. Market's irrationality to your advantage. It requires emotional fortitude.
A lot of fortitude. Okay, so Graham gives us this framework for dealing with the market's emotions. He also helps us think about our own approach, right? The defensive versus the enterprising investor.
Exactly. He recognized that not everyone wants to or can spend all their time analyzing stocks. So the defensive investor is looking for safety and simplicity. They want minimal effort, minimal stress. Think diversification, maybe focusing on large, stable, blue-chip companies, or what we now call index funds, though they weren't as common back then.
And the enterprising investor.
That's someone who's willing to put in the work. They enjoy the analysis. They're actively looking for bargains, maybe in less obvious places. They might take on a bit more calculated risk, aiming for potentially higher returns, but based on that deep fundamental analysis we talked about.
So it helps you figure out your own style, your risk tolerance, how much effort you're willing to commit.
Precisely. It's about aligning your strategy with your personality and circumstances.
And underlying both styles is this constant emphasis on intrinsic value and fundamental analysis, looking beyond the hype.
Always. Graham wants you to focus on the business itself. What does it earn? What are its assets? What are its prospects? Is it financially sound? He strongly warns against chasing market fads, getting swept up in IPO mania, or trying to predict short-term market moves. Know what you own and why you own it.
Okay, so we've covered these core pillars. Why does this book, written so long ago, still resonate so strongly? What are its enduring strengths?
Well, first, just the timelessness of the wisdom, market psychology, the importance of value, risk management. These things don't really change. They're as relevant in a tech boom as they were during post-war recovery. Second, the risk-averse approach. In a world often obsessed with quick gains, Graham's focus on protecting your capital first is incredibly valuable for long-term success.
That emphasis on not losing money seems key.
It is. And third, the psychological insight. Understanding Mr. Market, controlling your own emotions. This is huge. He was talking behavioral finance before it was even a field. And finally, you can't ignore the endorsements. Buffett, Munger, Klarman, countless successful investors point back to Graham. That carries a lot of weight.
Definitely. But it's not perfect, right?
Yeah.
Especially reading the original today. What are the challenges?
Yeah, fair point. The original text can be dense. It reads a bit like an academic work sometimes, which can be tough for a beginner. And as we mentioned, the examples, railroads, utilities, feel dated.
And what about modern investing tools?
Right. It has a limited focus on modern tools. Index funds weren't really a big thing yet. ETFs didn't exist. International investing wasn't as accessible. It doesn't cover those specifics.
But that's where the Zweig edition comes in again.
Exactly. That's the solution. The Jason Zweig commentary is the bridge. He takes Graham's principles and applies them to things we recognize: Amazon, the dot-com bubble, Enron. He shows how Graham's thinking helps you navigate today's market realities. It makes the whole thing much more accessible and, frankly, actionable.
Okay, so putting it all together, who is this deep dive and the book itself really for? Let's break it down. A beginner investor.
Yes, but with caveats. Be patient. Definitely go for the Zweig edition. It's foundational, but maybe not the easiest. Very first step.
An intermediate investor.
Oh, absolutely. It's a must-read. It will likely change how you think about investing, give you a solid framework.
What about a day trader?
Probably not the right fit. Graham's whole philosophy is the antithesis of short-term trading and speculation.
Okay. Financial advisor.
Essential reading builds that core fundamental thinking.
And someone pursuing FIRE financial independence? Retire early.
Very helpful, yes. The emphasis on low-cost, long-term, disciplined wealth building aligns perfectly with FIRE principles.
So the final verdict from our source material.
They gave it a 9.5 out of 10,
Okay.
but with the strong clarification that it's not a quick read, it's not a get-rich-quick scheme, it's more like A lifelong companion for your investment journey. It teaches you how to think like an investor. Indispensable if you're serious about managing your money.
A lifelong companion. I like that. And they even suggest a way to tackle it.
Yeah, a kind of reading plan. Weeks 1 and 2, chapters 1 to 8, the core philosophy. Weeks 3 and 4, chapters 8 to 14, digging into the defensive versus enterprising approaches. And then week 5 onwards, really use Zweig's commentary to connect it all to modern examples and solidify the ideas.
That sounds like a manageable way to approach a dense book.
Definitely breaks it down. So just to wrap up the main points, The Intelligent Investor gives you a blueprint. It's about rational, disciplined investing. It's a philosophy, not a formula for hitting it big overnight.
Right. And the real payoff from understanding this, from reading the book, is that it empowers you. You become a more informed, more strategic player in the markets. You move from just reacting to actually thinking and acting with purpose.
Well said.
So here's a final thought to leave you with. We live in this age of constant digital noise, right? Every feed is shouting about the next hot stock, the latest trend. You face a choice every day. Are you going to let Mr. Market's daily drama dictate your actions? Or are you going to cultivate the patience, the analysis, the discipline to be a truly intelligent investor? What part of Graham's wisdom resonates most with you, and how will you apply it to your own financial path? Something to think about.